Welcome to 2021. Wow, we made it, right? I mean, I don't know about you, but 2020, good to see that one in the rear view mirror for a lot of reasons, and I'm sure many of you share the same sentiment. That was a odd year. Unfortunately, a lot of the oddity, particularly with the pandemic, carrying forward into 2021. So we're going to take a look at some of the lessons that investors learned in 2020 on this morning's program. And maybe it's not lessons learned, maybe it's lessons repeated, if you will. So we'll spend some time talking about that, along with the fact, of course, it's the first Sunday of the new year. The holiday fell on Friday, so we have a clean break, if you will, once every 7 years where the markets close and we know exactly what the market closed at for the year. So then we can do a very accurate comparison of our annual exercise that we do every year. And that, of course, is our fearless forecast, a little bit of a tongue-in-cheek exercise that we've been doing on the program now for about 3 decades, I suppose. Back in those days, it was just Jack making the prediction, then it was Jack and myself doing it, and of course now it's just me making the fearless forecast, going out on the proverbial limb on the tree. Remember, we do refer to it as a tongue-in-cheek exercise in that you can't really predict the future. But of late, we've been on a little bit of a hot streak. So we'll share that with you, along with how we did last year and what the market actually did. And then, of course, we'll set the table for our fearless forecast for the year 2021. All that on this week's program, Dollars and Sense. Welcome, of course. Dollars and Sense, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on 96.9 The Game. Go Bucks, last game of the regular season. Can't believe, was talking to the producer Kelly before the program, can't believe the NFL made it through a full season, but it appears they did. So we're coming to you on 96.9 The Game, along with the news radio WFLA Orlando Network. Also, our program Dollars and Sense happens to be one of the top 25 financial planning podcasts on the World Wide Web, with over 15,000 downloads of our program at last count. So we appreciate all of our subscribers out there on the various social media channels, along with the podcast channels like iTunes, Spotify, and the like. My name, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life. Maybe that was one of the resolutions you had for the year. I want to change my life. Well, we can help you do that by providing superior investment results and peace of mind for the future through a successful and cost-effective financial plan. So here we are, the start of a new year. How did we do for our fearless forecast for the year 2020? That's our annual tongue-in-cheek exercise. Of course, nobody can predict the future. Let's just sort of reset the table of where we were a year ago. It seems like forever and a day, but a year ago when we were making the fearless forecast for the year 2020, unemployment was at 3.5%. Economic growth was humming along at between that 2-3% range, and the Dow closed out the year 2019 at 28,538. 2019, our fearless forecast for 2019 was actually one of our, if not the most accurate that we did. We actually had our fearless forecast for the year 2019 with the Dow coming in at 28,400. Lo and behold, it came in at 28,538. Super close, about 150 point difference. That was really pretty good. Again, predicting the future, so, take that with a grain of salt, I guess. Anyway, now, fast forward to what actually happened during the course of 2020. Unemployment was at 7.9% here at the start of the year, and then the economy for 2020, as a result of the pandemic, shrank at an annual rate of about 3.6%. Yet the Dow closed at just over 30,600. How did that compare to our fearless forecast? Well, our fearless forecast for the year 2020 that we did a year ago, 31,600. So about 1,000 points over, given the pandemic and everything else that happened. Hey, we're going to chalk that up as that was pretty close. 1,000 points seems like a lot, but when you do the math, that's within 3% of where the markets actually wound up. So think of it another way, that's like 97% accurate. So shoot, if one of my boys came home with a test score of 97%, I'd say that's pretty good. So we're going to give ourselves a little bit of a W on that, particularly considering all that happened during the course of last year. So for 2020, the Dow, and that's sort of what we always have done our fearless forecast on the Dow, which is really just a measure of 30 companies. So it's relatively narrow in terms of its scope. But so our fearless forecast for the year 2020, 31,600, which is what we did a year ago. Markets actually came in at 30,600. Not too bad if you think about it that way, particularly during a crazy pandemic year. So next up, we're going to take a look at the lessons learned for investors during the course of 2020. We're going to see how those apply going forward. And then, of course, later on in the program, we're going to get to some of the factors that are making our fearless forecast for the year 2021. So you don't want to miss that, and we'll have that here on the program. We'll take a break, and when we return, we'll talk about some of those lessons learned from the year 2020. Welcome back to the program, Dollars and Sense. So what are some of the lessons learned from the year 2020? Or should I say, probably we all know these lessons that 2020 taught us, but I guess it serves as a reminder. So there are certainly 4 key takeaways that we want to share with you on the program today. Lessons learned from 2020 that can certainly be applied not just here in 2021, but going forward as well. So this is Dollars and Sense, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game, also one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out and subscribe to us on your favorite social media channels or your podcast channels of choice. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment result and provides you with peace of mind for the future. So what are those 4 big key takeaways from the year 2020 that as investors we can apply going forward? And I think the first one to really wrap our hands around is this notion that markets don't perfectly reflect the economy. The markets as a whole don't necessarily take the temperature of things as they exist today. They look forward, they look ahead and try and see what things might look like in the future. It's often said that the markets typically are looking ahead 6 to 12 months down the road. And so if you think of what happened during the course of the year 2020, stocks effectively sort of bottomed out as a result of fear over the pandemic on March the 23rd. At that point, they had declined about 35% within basically a 30-day period of time. If, of course, you remember back to that March period of time, it was a very fearful time. A lot of unknowns, a lot of the government shutdowns were happening, and so the full lockdowns obviously had a dramatic impact on the economy, and the market at that point obviously responded dramatically quickly to those headlines. Employment skyrocketed up, and you know the rest. The reality is, though, that very quickly, if you think of March the 23rd, right, we were still in the peak of this pandemic, the early stages, if you will, of the pandemic, where the lockdowns have just started to begin, and the unemployment numbers and the closures across this country were just beginning, yet the market sort of started to turn pretty dramatically while the headlines were at the darkest point. And so the markets were really looking forward to ultimately that sort of not being the story anymore. If you think back to 2009 and the financial crisis, markets effectively bottomed during the financial crisis on March the 9th of 2009. Again, unemployment soaring, still in the midst of the financial crisis, much like we were in March and in just the beginning stages, really, of the pandemic. And if you go back to that March 9th, 2009 turning point in the financial crisis, sort of that bottom, and then the subsequent market started running up after that date, what you'll find is it took about 7 years after that date for the markets or the unemployment numbers to sort of hit the numbers that they were prior to the crisis. So as we all know, markets really look forward to what the future may be rather than a template for what's going on today. So the key takeaway there is, as investors, to really try and look past today's headlines, because certainly the market does that. And if you look at these statistics from prior crises and just how much the markets have started moving up, so the turning point, if you will, in the markets is always sort of in the darkest days of the crisis, much like we saw in the financial crisis back in 2008, 2009, and similarly last year during the course of the pandemic, where after March 23rd, the market sort of turned and continued to run up that surprised pretty much everybody, if you think of it in terms of just how dramatic the markets improved during the course of the pandemic, still raging on, still being in the very early stages of that. So key takeaway, look past today's headlines, if you will. The next thing is something that we certainly talk a lot about on the program, and it's simply this: it pays not to time the markets. If you got out in reaction to the beginning of the pandemic, then you missed a tremendous opportunity going forward during the course of the rest of the year. I actually was visiting with somebody last week for the first time, and they showed their results, and for the year they were down like 17% because they had gotten out in March and didn't know what to do after that. Well, if you look at what the markets did in the year 2020, they're actually up 15-16%. So if for that person that was down 17% for the full year, I mean, that's like a 30% differential in terms of what the numbers could be. That's pretty dramatic, and that's just as a result of this particular investor's behavior during the course of a single year. Well, a 30% difference is pretty substantial when you stop and think about it as it relates to your retirement. And if you just kind of look at the numbers, particularly over time, and these numbers go back about 40 years. So if we go back January 1 of 1980, fast forward to the end of August of 2020, that's about a 40-year time period. If you would put $10,000 in the S&P 500 index on January 1 of 1980, and think about all the things that happened over the course of that 40 years, that 10,000 would have turned into 700,000. That's a tremendous number. Here's the crazy thing. 40 years, that's about 10,000 trading days. If you miss just 5 days, just the best 5 days, instead of 700,000, you would have 38% less than that number. You'd have about just a little over 400,000. If you missed the best 10 days during that 40-year period of time, you'd have roughly about half of that 700,000 number, actually less than that, to the tune of a slightly more than 300,000. So we can't emphasize this enough. All it takes is to be out of the market during those good days, and you're going to be forever trailing in terms of the return that you could have got. Really underscoring the concept of it pays not to time the message. Key takeaway there, of course, stay invested. Number three, and I think this one is, I guess, particularly important given last year and the presidential election, and of course what we're doing on the program in the next segment, doing our feelers forecast. The reality is that forecasts are just forecasts. The weather man changes his approach every day in terms of what the forecast is, particularly here in Central Florida. Nobody can predict the future. The biggest risk at the start of the year 2020 was the trade dispute with China. Pandemic wasn't even on anybody's mind. Forecasters constantly change their forecasts. If we look at one large institution, Goldman Sachs, in March they cut their target on the S&P 500 to 3,000. Then in August, they raised it back to 3,600, and then November, they further raised it up to 3,700. So you get the point. Forecasters constantly change, and so forecasts are just that. The reality is that they are predictions of the future. Ignore them as best you can, because nobody can predict the future. They make for a lot of excitement, they get your attention, they attract your attention for that period of time, but the reality is forecasts are an attempt at predicting the future. That's why we refer to our exercise that we do, or that we'll be doing next segment on the program, as our feelers forecast, because we're feelers on it, knowing that it is in fact a tongue-in-cheek exercise. And I guess the next key takeaway for investors, and really for all of us as humans, is 2020 sort of marked the tech explosion, and not just in terms of the markets, because obviously the market performance, so for the year 2020, markets are up about 15-16%. A lot of that performance was dominated by the big tech companies. We've certainly talked about that before on the program. Somewhere upwards of close to 30% was driven by those tech companies that we all know, like Facebook, Amazon, Netflix. Those FANGs, if you're familiar with that acronym, those six companies really drove about 30% of the performance for the year. So the tech domination wasn't just in the markets, though. It was obviously in our personal lives, right? Because all of us had to shift to remote work, remote video conferencing, remote shopping. There wasn't anybody that didn't sort of experience that dramatic shift. I mean, if you look at what happened during the course of 2020, Tesla became the most valuable automaker. Airbnb, which is the online, booking somebody's home, Airbnb went public with a market valuation greater than that of Marriott, Hilton, and Hyatt combined. So Zoom became a household word, and so many other things from a tech perspective. So the message there, I think, is embrace, I guess, the new trends, become a techie of sort. The other part of the message is to make sure that you don't forget to be balanced. You don't want to be so overweight on this growth stuff. Even though last year was a good year, last year's already in the books. So be careful about being so overweight and chasing those companies, or that small sliver of companies that really contributed a lot to the performance for the year 2020. You really want to make sure that you're balanced in your portfolio between these growth companies, but also these value or dividend paying companies, these traditional companies like a Domino's or a Pfizer or something like that, particularly with the vaccine, right? Because these growth companies, that some of which are trading at close to like 100 times or more, some of them at price to earnings ratio, those are starting to look a little bit expensive. So those are the key takeaways for investors. Remember, markets don't perform perfectly with the economy. It really pays to stay invested. And remember, forecasts are just forecasted, and then make sure you're embracing all of this tech stuff. Whether you want to or not, it's here to stay. We're going to take a break, and when we return, we're going to have our feelers forecast for the year 2021 coming up next here on Dollars and Cents. So let's talk about our fearless forecast for the year 2021. Without further ado, we will turn to that, since this is the first Sunday program of the new year. Last year, as we mentioned earlier in the program, we were within 3% of where the markets wound up. So 97%, that's not too bad. The year before, 2019, we were within 150 points of where the Dow wound up. So that's almost like 99.5% accuracy. So we're on a bit of a hot streak, which probably means that we're due to run cold for this current fearless forecast, but we're going to share it anyway, along with some of the things that influences our fearless forecast for the year 2021. So welcome back to Dollars and Sense, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out on things like iTunes, Spotify, and the like. Or if you want to see a video of the program, you can also subscribe to our YouTube channel at Nelson Financial Planning. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life. Isn't that something that you want to do, particularly in a new year? Maybe that's on your resolution list. We'll be talking about some resolutions for the year 2021 in our next segment, but certainly our team can help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So before we get to our actual number in terms of our fearless forecast, we thought it always good as we engage in this sort of annual tongue-in-cheek forecast, because as we were talking about in the last program, forecasts are just forecasts. They are predictions of the future, and nobody can do this. This is just a fun exercise that we started 3 decades ago on this program. There are certainly some key things that we want to talk about as we look ahead to 2021 that we expect will be big drivers of what's going on in the economy and what's going on in the markets. And first and foremost of all, we would expect 2021 to be a comeback year, right? I mean, the shutdowns that happened during the course of 2020, the expectation is as the vaccine rolls out, then that you're going to have people being able to do some of the things that they were simply not able to do, particularly in the second half of the year as the world reopens from COVID. But beware the first half would be what we would say. This vaccine is sort of, as we described in a communication to our clients on Thursday, the last day of the year. It's tantalizingly close, but for many it's probably not close enough yet. And so as you see these rollouts and things like that sort of hit snags and less people getting it at this stage than what they sort of had originally predicted, then that's going to make for a volatile first half of the year. For the entire year, it's estimated that the U.S. economy probably going to grow about 3%, maybe a little bit more than that, following last year where overall it was about a 4% contraction. So certainly 2021, the year of the comeback, but watch out, it's not going to be a smooth one, that is for sure. Number two, interest rates. Low rates are here to stay. They are certainly going to be a big part of the story, but there's also a beware in that takeaway, because with the federal funds rate set to target at 0%, the reality is that there's so much liquidity in the overall economic system. There's so much cash. When you've got interest rates that low, there's a tendency to borrow money and then just to have that cash in the economic system. And if you think of it like the tides, I mean, injecting so much cash into the economic system, which is what the folks in Congress and the Federal Reserve did, and rightfully so, in order to offset the economic damage that came with the COVID lockdowns. But when you do that, it's almost like you're pushing the tide in. And when the tide comes in, everything rises, right? And the reality is that it really has done a tremendous job, if you will, at creating that rising tide. And you can look no further than sort of the recovery in the markets to see the impact of that. If you compare sort of the previous crises that have happened over the course of the past 20 odd years, and you go back to 2000, 2002, which is the Y2K, the tech bubble bursting, during the course of that decline, the subsequent recovery took exactly 1,872 days to recover, for the markets to recover to the prior pre-crisis highs. Okay, so 2000, 2002, the Y2K, the dot-com bubble, all of that happens. Markets go down. It took a pretty long time, 1,872 days, for the markets to recover to those pre-crisis levels. If you then fast forward to 2007, 2009, financial crisis, all of that, from that turn in March of 2009, March 9th of 2009, it took the markets a total of 1,426 days to recover back to those pre-crisis highs. In the year 2020, as a result of the pandemic, when the markets turned on March the 23rd, it took them no less than 128 days to recover the previous high pre-crisis. And stop and think about that, just how, 128 days versus these others, 1,400 days or 1,800 days. That's less than a tenth of the time for that recovery to occur. And so if you look at that and you kind of look at the prior history of crises and recoveries, and we know that, markets ultimately recover, but for them to recover this quickly, it's a testament to these low interest rates, this cash in the system. It also makes us wonder, and this is certainly a factor in our fearless forecast for 2021, is if the markets maybe have already priced in a lot of the recovery, a lot of the COVID recovery already. Because when you look at those numbers, it really does suggest that this market has recovered much, much faster than historical comparisons of similar crises. So that also sort of weighs on our outlook and our forecasts for the year 2021, is whether perhaps in 2020 the market sort of stole some of the recovery in terms of their performance that you would typically see in the year 2021. Similarly, the concept of this being a K-shaped recovery, right? Where you've got certain parts of the economy that are recovering and doing very well and others that are not. It's certainly kind of a winners and losers type of environment, if you will. And so there, I think the question is that you need to be careful about the indexes and owning the index. When we do our fearless forecast, for example, we talk about it in relation to the Dow, but the Dow is just 30 companies. It's just a small slice of the American economy, and those 30 companies don't typically change during the course of the year. If you look at the S&P 500, that's 500 companies, bigger cross-section, if you will, but also a cross-section that is a static cross-section. So we think that investors might be better off in more actively managed types of investments rather than just owning the indexes in terms of the performance, particularly in the year 2021, and to a certain extent for the year 2020 as well. The reality is that there's definitely going to be some winners and losers, not just in the particular sector, but also inside of different sectors. There's going to be companies that were able to adapt and continue on in light of the pandemic, and then others that are not. So we think that there's going to be a little bit of a split, more of a K recovery that also has impacts from an investing perspective, particularly versus index funds versus actively managed funds. And then, of course, 2021 is going to be the year of the release of the pent-up demand. One of my Christmas presents was an Instapot, and we actually used it the other day. And so how that thing works is it's like pressure cooking. And so when the timer is done, it's actually pretty neat how it all works. If you don't have one, it's like the hot item, I guess. Anyway, you then hit the valve that releases the steam, and the steam just, because it's high pressure cooking. So the reality is that I think 2021 is going to be a lot like that, particularly when you look at experiences that cannot be digitized, right? You can't digitize travel. You can't digitize going to a live entertainment. You can't digitize going to a sporting event, and you can't digitize going on a cruise ship. So the reality is that a lot of those experiences are going to come back. In places like China, for example, that are sort of a little bit ahead in terms of the recovery from the pandemic, you're already seeing air travel only down about 0.5% versus where it was, sort of the year prior. Here in the U.S., it's still down about 62%. And then the other thing to really be thinking about from an investing perspective is don't forget sort of the non-U.S. side of things. The fearless forecast that we do is on the Dow, which is U.S. companies, but be sure to look outside of the U.S. in terms of investing opportunities, because we think particularly in places like Asia, Australia, where the reality is that they're a little bit more ahead of where we are in terms of the COVID recovery. You may very well see 2021 as a year where the non-U.S. markets ultimately perform at a much better rate than the U.S. market. So make sure from a portfolio perspective that you wind up having that mix of U.S. and non-U.S. I think many people have sort of been siphoning off the non-U.S. for a while because it hasn't been doing as well. We could very well see 2021 being more of a turn where those international markets actually do better than the U.S. market. So those key takeaways, 2021, comeback year for sure, certainly unleash of pent-up demand, continued lower rates, that is for sure, versus the risk, right? The risk that the market already has sort of anticipated the recovery. It's the fastest by far in terms of the recovery, if you think about those numbers and those statistics we were giving earlier. And then sort of 6 more months, I guess, before I think everybody or the majority of us wind up with the vaccine. So we think those risks are going to perhaps weigh heavily. We think 2020 has already sort of taken some of the performance of what you would have expected to see in 2021. Remember, the markets last year were up about 15-16%. That's a big number considering what was going on economically with the pandemic. So we're calling for a more muted number in the year 2021 because of what happened, the strength of 2020. Our conclusion is to look for about 5 to 6%, which, by the way, is still a lot better than what you can get in cash and bonds. So here it is, mark it down. I know many of you do, and then you remind us of it going forward, and that's fantastic. So here it is, fearless forecast. We expect the Dow at the end of 2021 to close at 32,250, somewhere between that 5-6%. I think that comes in at the math comes in at about 5.5. So mark it down, write it down. We'll see how accurate we are for this year, 2021. Year-end target on the Dow, 32,250. That's our number. We come back, we're going to talk about some of the resolutions that you may want to add into the mix for the year 2021 here on Dollars and Cents. So here we are in a new year. Popular exercise to do is to make resolutions. It's January 3rd, so hopefully you haven't blown your resolutions that you made for 2021 yet. We're going to give you some, though, that it's not too late to adopt here on this segment of the program. Obviously, they're financially related as well. It's good to have some of those in the mix as well, besides the traditional, I'm going to exercise more and eat healthier and all that stuff. Yeah, that'll last another week or so. Anyway, welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning. So what are some of the resolutions we can all adopt for the year 2021, beyond the whole eat less, eat healthier, exercise more, and all that kind of stuff? And so we're going to talk about some of the things particularly that you want to focus on in the year 2021, particularly in light of the pandemic. And the first is perhaps the most important, and that is the importance of having an emergency fund. Talk about something coming completely out of the clear blue sky like we saw last year with the pandemic and the various shutdowns that then occurred. The importance of having an emergency fund, and a lot of people get tripped up on an emergency fund and think it's got to be $20,000 or $25,000. As little as $2,500. There's actually some research that they've done on this. And as little as $2,500 of an emergency savings fund makes the difference between muddling through a crisis and completely falling off the cliff. So understand that it doesn't have to be some huge number. It's important to at least get some type of an emergency savings fund. To get $2,500 in your emergency savings fund by the end of the year, that just means that you've got to save about $50 a week. Maybe less trips to Starbucks or Chick-fil-A or whatever the case may be. The reality is that $50 a week will get you an emergency savings fund at the end of the year that will be $2,500. Is that going to be enough for all crises? Of course not. But that's at least a start. And even having that makes a difference between muddling through and literally falling off the cliff. So first and foremost, get that emergency savings fund started. $50 a month, $50 a week will get you to that $2,500 number by the end of the year. So great resolution to have for the year 2021. The second resolution that we would encourage folks to make is, if you look at the stats last year, right? Coronavirus has claimed 350,000 people just in this country. That is a surprise end to a lot of lives. And so what that means is then that it's super important to review those documents that come particularly into play as at the end of life. So we're talking about wills, we're talking about powers of attorney, talking about healthcare service, talking about those types of legal documents that help set forth your wishes for medical care and, more importantly, after you're gone, where the money goes. It's also important to check beneficiaries, because a lot of people get confused on this and think that if their will says one thing, that's what's going to operate. The reality is that on many accounts, retirement accounts, insurance accounts, things like that, the named beneficiary that you set on those is actually going to trump whatever it is that's your will says. So it's important to review those wills, those powers of attorneys, and if it's been 5 years since you've even looked at them, we would encourage you to certainly take a look. And if you don't have them, it's certainly something to get on the resolution list for the year 2021 in terms of getting those as well. Next up would be making some cuts permanent, right? This is the year where we're forced to sort of change our habits. Maybe take a look at some of the things that you didn't spend money on, and is there a way to save money on that and make those changes permanent, so you wind up getting a good amount of money to be able to save for retirement. And then lastly, make sure you're investing in the stock market, right? There's no other place for a better return than that. And with that, we will wrap it on up and get on out of here. Hopefully you're able to take those suggestions and resolutions and apply them to the year 2021. This has been Dollars and Sense with your host, Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando.